Good afternoon, everyone, and welcome to our confidential report for May month. Quite a bit has happened since we last spoke a month ago. Obviously, a key element here is Wall Street. So let's just take a look at the S&P 500. Right, there you can see it. Obviously, we've done quite a bit of analysis here. One of the things that we have been aware of for the last 2 months is that we're in a correction. You can see here the initial correction was 10% from the record high of 2872, a 10% correction where we found support here at this level, which is the level 2581. So that was the support level. Then there was a rally off that support level, quite a strong rally, and then that came back down to find the support again at 2581, almost exactly, bounced that level twice, and then has been lifting off that level. What has become apparent in recent days, though, is that there is a triangle forming here with a downward sloping resistance line at the top. So obviously, before we can get out of this correction, we first have to break that resistance line. But the resistance line only has 2 points, so it's not very strong. And obviously we have to see what will happen in future. Last night was quite a knock for the S&P 500. It came down about 0.8%, but still looking reasonably good. As you can see here, the 300-day moving average, the simple moving average on this chart, is still trending upwards very steadily, and that indicates that this is not the beginning of a new bear trend, but rather just a correction within a bull market. And we can put more data on the screen. If we go to the 10-year chart, you can see quite clearly this is the long-term bull market, and what we're looking at over here is a correction in that bull market. Now, of course, other things have been happening on Wall Street. One of them is that the oil price, which has been rising steadily, and we'll look at a chart of that just now, is having an impact on interest rates in America. And the 10-year Treasury bill in America is at the 3% level, which is a sort of psychologically significant level. When it gets to that level, you start to find some investors will move out of equities and into Treasury bills, and that can be bad for the equity market. However, we are not of the opinion that this is going to be a lasting effect, and we feel that the current correction will resolve itself. It's now well over 2 months old, going to 3 months old now, but that is not a long time for a correction. The last correction lasted for 5 months and took the market down 14%. This one has lasted 3 months, less than 3 months, and it's taken the market down 10%. Okay, so that's Wall Street, and of course the impact of that on the JSE is worth noting. So we'll just have a look at that quickly at the JSE overall index. The JSE is directly influenced by what happens on Wall Street, as are all the markets around the world. Here you can see that we made a very clear hammer formation here on this day, which was the 4th of April, and since then the market has basically been trending up quite nicely, and we expect it to continue going up. The sideways downwards movement here obviously reflects the correction taking place on Wall Street. Now, of course, there are many things going on in the South African economy. We now are firmly into the Ramaphosa period, and probably the biggest legacy that he has from the previous president is the massive civil service which is accumulated in this country. At this stage, Davy Root, who's a well-known economist in Johannesburg, estimates that there are 3 million people employed in the civil service, and there is including state-owned enterprises like Eskom and Transnet and so forth, and that they account for roughly 35% of the total spending by the government, 35%, and that's clearly far, far too much. We need to cut that civil service right back so that there's more cash available for the projects that we want to engage in. The South African economy has 30 million people below the upper bound poverty line, the UBPL, upper bound poverty line, which at the moment in South Africa sits at 992 Rand per month. So anyone who receives or earns less than that amount is one of those 30 million people. And we need growth of somewhere around 4 to 5% if we are to achieve any kind of a dent in the poverty levels in this country. Right now, the growth is, last year it was 1.3%. This year, the various estimates range around 1.7 to 1.9%, and next year possibly slightly better than that. Mr. Ramaphosa, our new president, has been overseas on a tour, and he is trying to raise roughly $100 million US of foreign investment into the South African economy over the next 5 years, and that will be a huge achievement. If he can achieve that, it will certainly have an impact on unemployment and poverty levels in this country. The inflation rate is sitting at around 3.8% now, but we do not expect any more interest rate cuts. So we can't expect any further stimulation from the Monetary Policy Committee. But the economy is starting to lift off. There are definitely signs of an improvement in the economy. Retail sales were up 3.2% in January and 4.9% in February, which indicates that consumers are feeling more confident. The inflation rate is down. I think that that helps a great deal, and I think that they are feeling better as a result of Mr. Ramaphosa's election as leader of the ANC, and now of course his appointment as president. And I think that will have an impact on their spending patterns. They will of course draw more credit and spend that money, but that will be good for the retail sector and good for the economy. At the same time, Mr. Ramaphosa has now arranged for 27 new independent power producer contracts to be signed, which brings the total to 53. The objective of that program, the Renewable Energy Program, is to have 100 IPPs supplying roughly 17 gigawatts of power. And that 17 gigawatts is more than the combined full power output of the two new coal-fired power stations, Kusile and Medupi. So it's a very considerable impact on the generation of power in South Africa. The nuclear proposal seems to have completely disappeared from the news, and I expect that it will not be implemented any further, because we just don't need the power, and we also obviously don't have the money to do it. The Rand has been quite strong, but in the last week or two it has fallen back, and we're now looking at a situation where it is weakened by 1 Rand to the US dollar. So if we look at the chart here, you can see how we're still in that long-term strengthening channel, but that over here in the last few weeks or the last couple of months, there was definitely support at the 12 Rand and 8 cents level to the US dollar, and that support has clearly been broken now. So we're now sitting at about 12 Rand 50, around the 12 Rand 50 mark, having come from about 11 Rand 50. So there's a 1 Rand weakening, and before we get to this upper channel line, we can expect that Rand to weaken to somewhere north of 13 Rand 80. That is if it's going to go and find that upper channel line. So there's potential for it to go to 13 Rand 80 or thereabouts before a new strengthening pattern emerges. Of course, Cyril Ramaphosa is very aware of the impact of the strengthening Rand on industries like the mining industry. And I think that he doesn't want the Rand to get too strong too quickly, and this may be a part of that understanding. Anyway, as a private investor, you always got to keep your eye on the Rand, because a lot of our shares have got interests overseas, so a strengthening rand is bad for them. On the other hand, a lot of our shares are also producing a raw material or commodity here in South Africa, which they export, and a strengthening rand is generally good for them. So it's a mixed bag. Looking now at the commodity situation, if we look at the oil price, this is something that has changed quite a lot. I'm just going to look at the North Sea Brent oil price. Okay, there it is, and you can see it bottomed. This is the major fall that we had in 2014 when oil prices basically collapsed. The last half of 2014, they eventually reached a bottom here at the beginning of 2016, and since then they've been trending up. Most recently, however, the oil price has broken up to $75 a barrel, which is about half what it was when it was at its peak. Nonetheless, that has an impact throughout the world. It is probably the most important reason causing the level of interest rates on the US Treasury bill to start rising. And that, of course, has had an impact on the stock market in America, causing it to be less attractive to investors. So bonds are becoming more attractive, equities then become less attractive. Nonetheless, we think that equities will continue to rise, both here and in America and all over the world, for some time to come yet. Now, of course, during the last month or so, in our commodity area, we've had a very important High Court decision that the once empowered, always empowered rule will apply, and that mines do not have to keep on topping up their BEE shareholdings. So as their empowerment partners sell their shares, they're not required now to maintain their share level, their BEE share level at 26%. The new mining charter is being worked on, and we believe that the Chamber of Mines will probably give ground in one area, which is that they will allow for that charter to go up to 30%. So it will require, we believe, a 30% BEE holding in future, but that will only have to be achieved once. If the BEE, the empowerment shareholders, sell their shares, then that mine will not be required to maintain it at 30%. And I think also that the Chamber of Mines may well have negotiated to get a much longer life for this charter, probably somewhere around 10 years. And that will enable overseas investors in our mining industry to plan and to work with a much longer time frame, which gives them certainty. Of course, in our mining area, the platinum mines are in crisis. If we look at the platinum price in rands, just going to find the rand price here, you'll see that it has fallen from about 16,600 rand per kilogram, per ounce 2 years ago to its current level around 1,100 rands per ounce. So there you can see the peak at 1,600, and down here is where we are now at 11,300 rand per kilogram. So it's fallen from 16,600 to 11,300. And that has obviously had a huge impact on the platinum mining industry. It's dropped South Africa's share of the world platinum market from 75% to roughly 50%. A lot of that has been because these days about 25% of platinum, new platinum coming onto the world market, is recycled. It is recovered from old vehicle exhausts and recycled. And that has a major impact on the platinum market and puts a bit of a ceiling onto the platinum price. Other commodities are doing well. For example, the aluminium price has been going up very nicely. Aluminium is used all over the world in lots of industries, from shipbuilding to motorcar manufacturing. And here you can see the price of aluminium, how it's been trending up nicely. Recently, the United States government, obviously being driven by by Donald Trump, the president, arranged for Rusal, which is the biggest aluminium producer in Russia, to be blacklisted. So basically America is not buying aluminium from Rusal anymore. And Rusal is a big supplier. They are producing 6% of the world's aluminium. This caused all sorts of people who use aluminium to rush around the market and look for other sources of supply. And you've got a huge spike in the aluminium price, which you can see here. It has now recovered somewhat from that, back to the levels it was at, but nonetheless, there is a strong upward trend in the aluminium price, as you can see here. Our biggest aluminium supplier is a company called Hewlett's Aluminium, and if you look at Hewlett, you'll see that the impact of rising aluminium prices has not really been affected in that share yet. The share price is still falling, as you can see here. So there may be an opportunity in Hewlett's Aluminium if you're interested in commodity prices. Now, one of the things that you should do before we go on to talk about the individual companies, I'd like to just spend a little time talking to you about a thing called market carpets. If you go to the scan feature, which you see here on the screen now, underneath there's a section called market carpets. If you have this software, you should definitely investigate the market carpets feature. This is it. It's busy calculating. When it comes up, the default is set for 1 day. See that, 1 day. But let's look at a 3-month chart. So it recalculates now over the last 3 months. And what it's showing you here is the various sectors of the stock market, from green being the best sector to this red down here being the worst sector over the past 3 months. So if we go to the best sector, we see that it's the healthcare sector and that it's gone up 15.4% over the last 3 months. Conversely, the JSE housing sector has gone down by 72% over the last, that's the household goods sector, has gone down by 72% over the last 3 months. Now what's interesting is to play around with this and look at what happens after 6 months. So we get it to recalculate the same numbers, but after 6 months. Now you can see that the general retailers have gone up the most over the last 6 months, 32%. And that banks are not far behind them. The JSE banking index has gone up by 26%. And if we go even further out and look at 1 year, then you'll see that the pattern is starting to become fairly standard now. There are the general retailers. And by the way, within the general retailers, you see all these little boxes. They are the individual shares. So if you put your mouse over that box, you'll see that that is Home Choice, and it's gone up by 37.5% over the last year. And this one here is Curra Holdings, which has gone down by 24% over the last year. And this one is Verimark, which has gone up by 67%, and so on. So you can look at the individual shares in the sector as well as the sector itself. What is interesting here is the banking sector, I think, because that has performed very well. So this market carpets is designed to help you to search through or to look at the JSE sector by sector over a period which you select. And then you can see which sectors are performing well and which are not. So now I'm going to close this and just look at the JSE banking index. Okay, there's the banking index. Now I'm going to look at 2 years. And what I want to point out to you is that 2 years ago, there was a short time when the JSE banking index was on a dividend yield of 5.7%. The dividend yield is shown up here on your chart. So if I put my mouse back there, you can see 5.7% dividend yield. And obviously that is very cheap for a sector which is full of blue chip shares like Standard Bank, First Rand and so on, and Capitec. So all those shares on average were on a dividend yield of 5.7%. You may recall that we are always encouraging you to look for any blue chip on a dividend yield of 5.2 or 5% or more. So here you had opportunity to get into high quality banking shares when they were relatively cheap. And as you can see by the movement of the index, the index has gone up very nicely since then. So that was a buying opportunity. At the same time, the price earnings ratio was 9.9%, 9.9, under 10, which is very unusual for the banking sector. So you need to make yourself, you need to be alert to these types of signals that come through from the market from time to time. During the last month, we've also seen another interesting development on the JSE, and that is that Sanlam has decided to register to list with the new stock exchange A2X. Now A2X is still very small, and Sanlam, when it came in there as the 14th biggest share on the JSE, caused the A2X market cap to multiply by 5. So it's had a huge impact. But what is important here is where Sanlam goes, so will other companies. We expect a steady flow of big listed companies to move from the JSE to the A2X, or at least to open a secondary listing on the A2X. The A2X, their dealing costs are about 40% cheaper than the JSE at the moment. So clearly we're getting some competition into this marketplace, and the JSE is not going to have the monopoly it had all these years. Now it's going to have to compete on brokerage and other dealing costs with other stock exchanges. A2X is by far the most interesting of the 4 new stock exchanges that have registered and have started trading on in South Africa in the last 3 or 4 months. All right, now I'd like to just consider Edcon. Now Edcon is an unlisted company, but it's a very big company. We're all aware of it because it owns Edgar's, and Edgar's is a very big clothing retailer in South Africa. But it's a clothing retailer that is really under pressure. There's a steady demise, a steady fall in this company. They've closed 200 stores in their most recent financial year. Their market share is being eaten away on both ends. On the lower end, the cheaper end, by stores like Pep and Ackermans, and on the upper end by new companies coming into the market like Cotton On from overseas, who are offering a very competitive, very high quality product to the consumer. So in the middle is Edcon, and they are losing market share at the top and the bottom of their marketplace. Personally, I don't think Edcon will be around for that much longer, but it's a big company and will probably take a while. During the last month as well, we've had an interesting situation. We've had two listings that were coming to the market, big listings that were looking at raising a lot of money, and both listings have been cancelled. The first one is Consol Glass. Now, Consol Glass is a well-known South African company. It was listed before and closed its listing in 2007. And it wanted to list again and raise 3 billion rand to pay back its debt. And it's got significant debt, about 2.3 billion rand of debt. But in the most recent financial year, Consol Glass actually made a loss, mainly because they had to pay 625 million rand in interest, just in interest on their debt. And that put them into a loss of 80 million rand. So obviously, investors communicated with Consol and said, we're not going to support this. We're not going to put our money into Consol Glass just so that you can pay your debt off. You have to get your balance sheet looking better before you come to the JSE. The other company that was going to list was Sagarmatha. By the way, Sagarmatha means Mount Everest in Nepalese, in case you're wondering where that name comes from. Sagarmatha, Sagarmatha. This was Iqbal Surveys company coming to the market, and their first endeavor was going to be to buy Independent News, which is a big newspaper owner in South Africa. However, obviously, the JSE then refused to list them because they hadn't lodged their financials with the Companies and Intellectual Property Commission, the CIPC, so they haven't complied with all the JSE requirements. So both of these listings have been cancelled right at the last minute. Consol was going to raise 3 billion rand and Sagamoto was going to raise over 4 billion rand. Now they may list, of course, in the future, but it's very interesting to see that happen. It's quite unusual for big listings like this to be cancelled at the last minute, and of course very costly as well. Another new listing that is coming to the market and we think will be very successful is a company called Libstar, which will be called Libstar. It's planning to list on the 9th of May. It's a diversified food manufacturer. And in the year to the end of December 2017, they produced turnover of 8.8 billion, out of which they made a profit of 594 million. Now this company, Libstar, is the main producer of household brands. So if you go into Pick n Pay or ShopRite or Woolworths, you'll see that they've got various household brands, which are their own brands. And this company makes most of the brands for Pick n Pay, Woolworths, Spar, and ShopRite Checkers. So that's one of their main businesses. They also have quite a lot of their own brands. I'm sure you're familiar with the brand Denny's Mushrooms. That belongs to them. And other brands which you are familiar with. They compete directly, of course, with other food suppliers like Tiger Oats, Rhodes, RCL Foods, and Pioneer Foods. And they will come to the market on the 9th. The PIC owns 16.8% of them. That's the government pension fund. They own 16.8 already. And most of the company is owned by an investment holding company called Abraaj, A-B-R-A-A-J, which owns 60%. So this company is coming to the market. We think it'll be a successful listing. But don't forget our advice, which is to always let the market tell you what the price of the share should be. It's not always straightforward, you know. And there are often many things which you don't know about a company when it lists, even if you've read through the pre-listing statement or the prospectus of whatever you've seen. Now another company that's come to the market recently is Core. Now Core is an Australian company and it's now taken a secondary listing here on the JSE. They mine and produce potash, which is really produced for fertilizer, so that it's used in the manufacture of fertilizer, but their mine is in the Democratic Republic of Congo. So this is quite a risky operation. First of all, because it's located in the DRC, and secondly, because it's a commodity company mining potash. However, it is interesting because it's got a huge tenement. In other words, it's got a huge area of land where it can mine, approximately 3 times as big as it's currently mining. So it could actually triple its size. That's the point. Now the share listed on the JSE just the other day. I'll put the graph on the screen for you. Of course, there's not very much to see. As you can see here, it opened at about 185 cents, and it's been trading around that level, but has dipped down now to about 150 cents. And clearly it's a high risk, but there is big potential in this share. It's up to you whether you want to take that risk. But you can see the benefit of not rushing into a share when it first lists. I mean, if you'd gone into this share straight away, you'd have paid 185 cents or more. Now you can buy the same share just a few days later for 150, and it may fall further. But there is obviously potential in this company. So there are 2 listings for you to look at. Now the next share I want to talk about is our old friend Steinhoff. Now Steinhoff, you remember I advised you to put on a 65-day exponentially smooth moving average and then to wait for the share to break up through that moving average. Now here you can see there's your 65-day exponentially smooth moving average, and it's been falling and falling and falling, although as Steinhoff share price flattened it out, this moving average has fallen more slowly, so that the 2 ends of the tweezer are slowly coming together. Now you can see that Steinhoff has now fallen below 2 Rand a share. It's now below 2 Rand. And the exponential moving average is still sitting at 6 Rand 63. So it's 3 times as high as the price still, which means that there's probably further downside potential. Personally, I'm now beginning to think that Steinhoff is not going to make it, that sooner or later it's going to be liquidated or broken up and sold off. There's a lot of problems here. And I see that Christo Wiese, who was the chairman of Steinhoff, is also suing the company for 59 billion Rand. So he's joining in to try and get what he can out of it. I'm not sure that he'll get that, because under Dutch law, as a director of the company, he is fully responsible for what happened to it himself. So he probably won't succeed with that. But with the class action lawsuits that are coming out of the Dutch environment, and remember, this company is listed in Holland, so it falls under Dutch law. And I think that with that class action lawsuit, you're probably not going to see this company recovering anytime soon. That's my view. And they may well go into liquidation at some point. But you see, if you use the 65-day exponentially smooth moving average, you don't really care about that, because then the share ceases to be of any interest. The only time you become interested is if the share price starts to move back up and breaks up through that 65-day moving average. That's what you'll become interested in. Another share which is also in a similar kind of situation is Resilient. Now, Resilient is a property company, and it used to be the absolute darling of the property market. All the big institutions had huge holdings in Resilient. And here you can see, once again, I've put on the 65-day exponentially smooth moving average, and that moving average has come down quite a long way as the share has fallen. You may recall that 361, which is an asset management company in South Africa, published a very negative report back in January this year about Resilient, and said that the 4 companies which make up Resilient, which are Green Bay and Rockcastle and Resilient itself, and there's a 4th one, had been manipulating the share prices, their share prices, buying and selling each other's shares in the market, and thereby manipulating the price. And as you can see, that caused the share price to tumble from where it was at about 150 Rand a share all the way down to about 50 Rand a share. So it's offloaded more than 100 Rand a share. And in a situation like this, where you get a blue chip share that's collapsed like this, we recommend that you put on a 65-day exponentially smooth moving average and just wait. Now, unlike Steinhoff, we believe that this company will recover. And here you can see that cup and lip formation. There's the cup at the bottom here, and over here is what we call the lip. This is the lip, or cup and handle. All right. Now, this is a formation that was developed by Mr. O'Neill, who runs a very important stock market newspaper in America. And we believe it's a worthwhile formation. If you break above this resistance here, you can see there's resistance. I can even put in a line for you to show you that resistance. Let me see. Okay, from there, you can see that there's resistance here at about 58 Rand a share, roughly at that level. So I'm just putting in that resistance line for you. But if we break up through that 58 Rand 50 resistance, and we break this moving average, which is now less than 10 Rand above the current price, then we believe that this share is in a recovery mode, and you may well make a lot of money by buying into it at this level. Remember, it's just a few weeks ago, at the beginning of this year and late last year, that the big institutions were buying this share at 150 Rand. So if you can get into it at, let's say, 70 Rand or somewhere around there, you're doing a hell of a lot better than they did. You're buying it for half price, basically. And it has very good properties, both inside South Africa and also overseas in Europe. So it's got some real merit. and you would be getting in close to the bottom of this trend, we believe. We certainly don't see a lot more downside potential in Resilient. Okay, I'd like to just move on to Naspers. I know a lot of you are interested in Naspers. Everybody in South Africa needs to be interested in Naspers. And the reason they need to be interested is because Naspers has a market capitalization of 1.2 trillion rand, not billion, trillion rand. That makes it by far the biggest share on the JSE, and it accounts for 19%, just under 20% of the market capitalization of the JSE top 40. So you can see it's very, very important. And you can see how the share has been drifting down. It reached a high point over here of 4,090 Rand, and it's drifted down, drifted down, drifted down. And over in this area here, we were looking at prices below 3,000 Rand. So it offloaded 1,000 Rand a share, and now it seems to be finding some support at this level. So the important thing about this share is that it has a net asset value of 5,000 Rand per share, but you can buy the shares at last week's closing price of 3,059. So you can buy 5,000 Rands worth of assets for 3,059 Rand. That's quite interesting, we think. Obviously, a key factor here is the strength of the Rand. And a major reason why the share has fallen since Cyril Ramaphosa came into office is because the Rand has strengthened quite significantly. But as we discussed earlier, in the last week or two, the Rand has fallen back by 1 Rand a share, and it could fall back further. So maybe this is an opportune time to get into Naspers if you want to buy the share. Of course, Naspers, its biggest asset is 31% of a company called Tencent, which is listed in China, and they have a huge investment in the Chinese cell phone and social media area. So they are like the sort of Facebook of China, you could say. And it's a very successful company and very profitable, and that Naspers bought them a long time ago and paid very little money for them, and now they dominate the whole Naspers business. All right, let's consider another property share, Accelerate. Now this company is interesting because it owns the Fourways Mall, and you may be aware if you live in that area. I'm sorry, I've got the wrong share here. There it is. You may be aware that if you live in Fourways, that the whole Fourways Mall is being upgraded and expanded enormously. In fact, the Fourways Mall is being increased to 178,000 square meters, which will make it nearly the same size as Sandton. They're putting in some very interesting features. They've got a new thing called Kidzania, which is a place where children can go and have a shopping experience similar to their parents. And it's been a very successful thing overseas, Kidzania. So it'll be the first time it's making an entrance into the South African market. And of course, this huge mall that is being built at Fourways, the objective is to make a new Sandton City effectively. But what I read in the press is that in America, these mega malls, these mega shopping malls in America are actually on the out. They are becoming ghost towns. Less and less people are going to shopping malls because more and more people are shopping online. So I'm wondering whether this is a good investment, this Accelerate. But you can see here, if you look at the chart here, you can see that it has produced a very convincing saucer bottom. Now, saucer bottom is a very bullish formation in a share like this, and it shows that people are steadily buying up the share, and they believe in its long-term prospects. So perhaps I'm wrong about it. Maybe it will take South Africa a long time before online shopping becomes a factor in the consideration of building new shopping malls. Okay, now I'd like to move on from there, and I want to talk about two shares which I think represent a good buying opportunity for private investors. The first one is a share called New World. New World is a diversified consumer goods company. They sell all sorts of different products and manufacture some of them. They sell everything from liquor to furniture and consumer electronics. So those are the kinds of businesses they're in. So they're very much linked to consumer spending. But their profit for the 6 months to February was up 28%, sorry, on a 16% increase in their turnover. That's pretty impressive, you know, to increase your profit by more than a quarter on a 16% increase in turnover. The interim earnings per share to the end of February were 400 cents a share. And they are very confident that by the end of the year they will have produced earnings of 800 cents a share, 8 Rand a share. Now at the current price, they are trading on a price earnings ratio of less than 5. I mean, that's ridiculous, isn't it? That is really ridiculous. Their dividend yield is 6.16%. This is a big company. I mean, this is a company that is highly profitable, generating good turnover. It's just the problem with this company is that the volume traded every day on the JSE is really too small for it to be worthwhile for the big institutions. But that represents an opportunity for you. As a private investor, you can jump into the share now and then benefit when the big institutions realize that this is a good share. And of course, this company will grow with the South African economy. So as the economy here is recovering, so this is a company with its emphasis on consumer goods that will benefit directly from any increase in consumer spending. So that's one share that I wanted to show you. The other share that I thought would be very interesting for you to look at is a share called Cartrack. Now, I have mentioned Cartrack before, but I just want to bring you up to speed on this share. And again, I'm going to put a 2-year chart on the screen. You can see how the share has gone up very nicely and is performing very well. Now, Cartrack is in many ways a private investor's dream. It's a service business. As you know, they supply tracking mechanisms for motor vehicles. And they're very, very good at this. And they extended their business overseas. They're selling car tracking all over the world now. They did a 1.2 billion Rand turnover last year. 1.2 billion Rand. Just from the fees they're getting from tracking devices that they put into cars. And that, of course, is what we call an annuity income. In other words, it's based on a debit order. Whoever is paying that money is paying it into Cartrack every month by way of a debit order, which means that before the month starts, before the beginning of the month, this company already has made a profit. They've covered their overheads and they're already making a profit. Anything they sell that month is just bonus and goes straight to the bottom line. So for me, it's a very interesting company. They have no working capital. They have no stock, no debtors. They don't have a huge staff of unskilled and semi-skilled employees. So they don't have any problem with unions. And they are a company where people pay in advance for what they get. So the result is that this company actually has negative working capital because they still run their creditors out 30, 60 or 90 days or whatever they can get, but they have no debtors book and they have no stock or very little stock. Again, the interesting thing about this company is that the volume traded every day is just too little to attract the attention of the big institutions. At the moment, the average value in the share every day is 1.5 million Rand. So 1.5 million Rands worth of shares are changing hands every day in this company. And that's just not quite enough for the big institutions to really start to take an interest. And that means it's an opportunity for you. Their price earnings ratio is 19. And that's roughly the same as the JSE's average. We believe that this is a well above average company, that it will continue growing steadily over the years and expand its business into various new parts of the world. They've basically got virtually unlimited blue sky potential. So we say you should be looking at that share. Now I'd like to emphasize that there are notes which will be going up on the website today, and you must have a look at those notes, because there's a lot of things that I talk about in those notes that are not covered in this webinar, and you should look at them. Otherwise, I wish you good investing for the next month, and I will see you on the first Wednesday in June. Thank you.